Hello, my name is Mike Sinabaldi, and welcome to this week's video edition of Heard on the Street. In this edition, we're going to take a look at the following markets: the S&P 500, and I'll briefly touch upon the DAX and FTSE 100. The first market we're going to talk about is the S&P. I'm going to spend a considerable amount of time on this market today. If you've been following along with me, you'll notice that I've taken my daily charts up one magnitude of degree. I've done so because I feel it best describes the current wave structure. We know from our previous work that the wave count is mature on the lower time frames. But what about the higher time frames? Looking at the monthly combined contract, a few things should stand out. Notice that the market has spent the greater part of the past 2 years rallying and has now reached overbought levels which are consistent with the thought that a decline is near. Nearby resistance is 1343.60. If you're bearish, you should be concerned with the fact that the advance from 1,440 has a greater slope than the previous advance. While this by itself would not negate the bearish counter trend wave count, it does raise the possibility that the bullish count may have some merit. For example, what if wave 3 ended at 1574 and the wave 4 decline to 1665 unfolded in an expanded flat correction? A, B, C. If so, the alternate count is bullish and wave 5 of the grand supercycle is unfolding. That implies a new recovery high, doesn't it? But looking a bit closer, the volume signature doesn't match the wave personality. Volume should be expanding, not contracting. Therefore, I'm sticking with my bearish stance, but I think traders should be prepared for more upside potential than most Elliotticians call for. Here's why. At the weekly chart level, the candlestick charts clearly show that every minor correction has been bought on 4 occasions from 1003. Here, 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 and now here. This tells me that the bulls are still in control of this market. I had been watching the 1.272 and 1.382 reverse Fibonacci extensions for possible failures and the completion of the butterfly sell pattern. Both of those levels were taken out, and price continued to make new highs. The butterfly sell is still applicable, and sometimes the pattern completes at the 1.618 reverse Fibonacci extension. Note that the extension is in agreement with the next area resistance of 1341.80, where wave C of wave 2 equals 0.618 of wave A. Also note this range corresponds to the resistance at the monthly chart level of 1342.60. At the daily chart level, from wave B, we have completed waves 1, 2, 3, 4, and working wave 5 of wave 2 circle. Again, I'm looking for a further rally in this market to complete the pattern. The 240-minute chart level shows my expectations for the remaining subdivisions of wave 5 of wave 2 circle. I'm looking for a small push upward to complete wave 1, followed by several down-up moves. And finally, from the 60-minute chart level, there is a zone of heavy resistance surrounding 1310 to 1315, where I'm anticipating that wave 1 may end. Of course, there is a distinct possibility that my analysis calling for a larger bullish move is incorrect, and that wave 5 of wave 2 circle could end in the same vicinity. My analysis of such is valid as long as support 1 holds. A print below support 2 would damage the largest bullish case and possibly indicate that wave 2 circle had ended and the resumption of the bear market had returned. The next market that I'll cover is the DAX. At the weekly chart level, the market has completed wave 4. The risk in the bullish trade is now to the downside, and there is limited upside potential. I maintain that wave 5 of wave 2 circle should terminate near the previous second wave at 72.70. However, one of the relationships between wave A and wave C points to the termination of wave 2 circle, whereas wave C equals 0.618 of wave A at 75.41.50. As more of the wave structure unfolds, I can narrow the targets and update readers with a more detailed discussion of the market. The final market that I'll cover in this week's edition of Heard on the Street is the FTSE 100. Price has remained within the corrective price channel. As such, I maintain that the advance since the low of 3443 is a counter-trend rally. Like the DAX, the FTSE's advance is stretched further than anticipated and is nearing its previous second wave. Heavy resistance at 62.1350 to 62.1450 are common wave relationships between wave A and wave C, as well as the internal subdivisions of wave C. Should the market push higher, then the most common relationship exists where wave C equals wave A at 66.46. I hope you found this video helpful. Have a great week and best of trading.